Following the largest Fed hike last month, the mortgage interest rates in Singapore are rising. Is it ever going to drop? Should I wait to buy? Let's find out. Before we start the video, just to put out a disclaimer that this video is made on the first week of July and these are just my opinions and I shall not be responsible for any loss of money in time to come, especially for DIY consumers, as there is never a one-size-fits-all strategy. With that aside, let's dive into the video. So the Fed essentially controls the interest rate where banks and other financial institutions borrow money at. The Fed hikes are actually an attempt to adjust the cost of borrowing and to stop the affected economies around the world from plunging into another Great Depression like the one we had in 1920s. The most recent comparison of a high interest rate in Singapore is actually in 2006, right before the global financial crisis. I was still drinking milk. This goes way back to the subprime mortgage crisis, when the US property prices were crazily cheap and the interest rates were very low. This actually allowed the high-risk buyers to take up loans easily. So when the housing bubble in the US burst, the high-risk owners, they could not refinance to a lower interest rate. So as a result, many people had to default on the loan. That actually set the Great Recession of 2007 into motion. Coming back to Singapore, interest rates in 2006 actually ran up to as high as 4.5% and this lasted for some time. So there are three types of mortgage in Singapore. Number one is the floating rate, which is a combination of the bank internal rate and the number we call SORA. And in SORA, the sky is the limit. The second type of mortgage interest that we have in Singapore is called the fixed rates. It usually locks you down for 1 to 4 years. And lastly, the HDB concessionary rates is an option if you are buying HDBs. Just like the name, the floating rates actually changes periodically as it floats around the market. Usually is pegged to SORA, which stands for the Singapore Overnight Rate Average. Although it's called overnight, it's actually when the banks lend each other extra funds for one day, and the transaction only takes place from 8 AM to 6:15 PM based on the volume and the interest rate they charged. Comment down below if you'd like me to talk about how SORA is actually calculated in details. So they then take the volume weighted average to consider it as the daily rate, and using the daily rate it forms the average of 1 month SORA, 3 month SORA and 6 month SORA. For floating rates in Singapore, the banks, they usually uses the SORA as a base in addition to their internal spread. On the other hand, fixed rates are rates that don't change for a set period of time, ranges within 12 months to 48 months. If you are someone who is more grounded and prefers stability, fixed rates are usually more suitable for you. And for HDB buyers, the HDB concessionary rates are actually very similar to fixed rates, which is always pegged at 0.1% above your CPF OA interest rates. But the interest rate is increasing, then how? Don't worry, according to MAS, your ability to borrow money is always done at a stress test at 3.5%. Furthermore, we have the total debt servicing ratio, the TDSR, is in place to prevent us from over-leveraging. So for now, there's nothing to worry just yet. So to put things in perspective, every 0.5% increase is about a $200 to $500 increment per month, depending on your loan size and your tenor. But you must be wondering what happens if the interest rates rise above 3.5%, like what happened in 2006. Okay, so many local banks have actually made a prediction that by the end of 2022, Fed rates will rise to 4% by the end of the year. So that's something we have not seen for 16 years, since 2006. So as you can see from this chart, during the US recession crisis in 2006, interest rates were very high and so were the property prices in Singapore, which actually lasted for more than a year before slowly correcting itself. However, while the interest rate started to calm down, the property prices went up once more to then all-time high in 2013 before the multiple cooling measures sequence takes place. And in 2015, interest rates rose again until the COVID-19 hits, but there was no drastic impact on the property prices as it went mostly sideways in general. So from this data, we can safely assume that the interest rates does not directly impact the property prices in Singapore. So the upcoming rising interest rates does not prove that property prices will fall. Will property prices drop? That's a topic for another day where I'll share more on the potential upcoming housing scene. So my friends, be prepared and invest wisely. If you're not sure to wait or to take action, reach out to me personally and I'll be happy to guide you through your thought process and navigate us through this hot mess. So if you like this video, do give it a thumbs up, it really helps me a lot. And as always, this is the simple truth in today's society of homes. I'll see you in the next one.
Society of Homes.